Hi, everybody. This is Alan Elman, the Blue Collar Investor, and welcome to this BCI podcast number 46, titled Should Delta Be the Sole Criteria for Covered Call Writing Strike Selection? And we're going to be using a real-life example with Intel Corp, which trades on the NASDAQ exchange under the ticker symbol INTC. Over the years, I've received a lot of questions regarding what delta should I use when selecting my strike prices for covered call writing. Now, I think what we have to do is we have to determine what our goals are using the covered call writing strategy. Now, certainly we're looking to make money. That's number one. But how much money and how much risk are the factors that only we can determine as to what will be appropriate for our particular trading style. But the goal that I know isn't number one on our list is achieving a certain delta for our strike prices. So let me just say right off the bat that the answer is no, delta should not be the sole criteria. However, every strike that we end up selecting will have a specific delta, obviously. So let's start off now by defining delta, and we're going to define it from three perspectives. Now, delta is one of the 5 option Greeks. These are factors that determine the pricing of our options and also the risk that helps measure the risk of our option positions. So we have delta, gamma, vega, theta, and rho. Gamma is simply a second generation delta. Vega relates to implied volatility, theta, time value erosion, and rho is impact of interest rates on our options. So those are the 5 option Greeks, but in this podcast, we're focusing in on delta, which actually can be defined from 3 different perspectives. First, it's the amount that an option price will change for every $1 change in share price. So for example, if a stock is trading at 50 and we sell the 50 call for $2, and the price moves up $1 and it has a delta of 50 or 0.50, we would expect the premium to move from 2 to 250. Now, if the $50 stock drops by $1, we would expect that $2 premium to drop by 50 cents, so to $1.50. So that's one perspective of defining delta, the amount the option price will change for every $1 change in the share price. Now, another definition of delta is the equivalent number of shares represented by the option position. So as an example, if we own 2 contracts which have a delta of 0.5, that's a +1. That's the same thing as owning 100 shares of stock. And this becomes significant for portfolio managers that are looking to minimize market risk and looking to achieve as close as possible to a delta neutral portfolio. So that definition of delta really applies more to portfolio managers than it does to us retail investors using option selling strategies. Now, the third definition of delta is the percentage likelihood that upon expiration, the option will expire in the money, or stated differently, with an intrinsic value component to it. So, for example, an in-the-money strike will have a higher delta than an out-of-the-money strike because it's more likely to expire in the money. So those are the 3 perspectives of defining delta. Now let's talk about applications. Now, call buyers will factor in delta because they want to know how much value their calls will change for every change in $1 of the underlying security. So they're hoping to be directionally correct, and as the price of the underlying changes, how much more value their option will represent. Now, as I said before, portfolio managers will look at delta neutral portfolios to minimize overall market risk. Now, covered call writers, they may want to know the likelihood of exercise, especially in non-sheltered accounts, where they may not want their shares sold because they might end up having to deal with some negative capital gains issues. Also, in the money strikes will offer more downside protection in volatile and bear markets. And so those would be higher delta positions, and lower delta out of the money strikes will tend to give us the opportunity to generate additional premium over and above option premium in terms of share appreciation. So if we were to break down the moneyness of the strike, out of the money strikes have deltas between 0 and 0.5 or 0 to 50 for the contract, at the money 0.5 or 50 for the contract, and in the money 0.5 to 1 or 50 to 100 for the contract. So the deeper in the money we go, the closer to 1. The deeper out of the money we go, the closer to 0. Now, if we were to look at a chart of delta as it relates to the moneyness of the call strikes, all the way to the left of the chart on the bottom, you would have the deep, deep, deep out of the money strikes having deltas approaching 0. And then the arrow would go up in a 45-degree angle to deep, deep in the money strikes, where the deltas would then be approaching 0.1 or 1, or 1 or 100 rather. So deep out of the money strikes have deltas closer to 0, and deep in the money strikes have deltas close to 100. So let's see, what are our delta conclusions now based on the information that we've stated so far? Well, low delta options are less likely to be assigned. So we might want to go deep out of the money in that particular case. And they also offer the greatest opportunity for additional share appreciation. So if we had a stock at 50 and we were looking at the 57 strike, that's deep out of the money. We have an opportunity for $7 per share profit if share moves up from 50 to 57. Plus you get your option premium. Now, high delta options, they have the highest exposure to assignment because they're more likely to expire in the money or with intrinsic value. But they do offer additional downside protection in the form of intrinsic value. At the money strikes with deltas around 50, or out of the money strikes with deltas closer to 0, will not have that intrinsic value component. So high delta options, deep in the money options, will give us additional downside protection. But they offer no opportunity for additional share appreciation. So the moneyness of the options have pros and cons, as will the related deltas of those positions. So if we were looking at delta stats on Intel, trading at 58.90 at the time that I checked an options chain on that, we would see that the 58 and 58.50 in the money strikes, 58.50 very slightly in the money, and then we look at the 59 and 59.50 out of the money strikes. So the deeper in the money we go, we would expect to see higher deltas. So the 58, for example, showed a delta of 76. The also in the money 58.50 strike showed a delta of 63. Now the out of the money strikes, we would expect to see lower deltas. And the 59 had a delta of 0.49, 49. It's very close to at the money. But the 59.50, deeper out of the money strike, had a lower delta of 35. So every strike will have a delta, but it's how we get there. We don't get there by starting out by naming a specific delta. We may want a lower delta because it's a bull market and we want the opportunity for additional share appreciation. We may want a higher delta in a bear and volatile market where we have that additional intrinsic value component for the additional downside protection. So we could craft our covered call writing strategy based on what's happening right now. And then that will end up with a strike that will have a particular delta. But there is no one delta that's correct for all situations. Not to mention the fact that your own personal risk tolerance will also impact our strike price selections. So if we're going to develop a strike selection game plan incorporating delta, we would first set an initial time value return goal range. For me, it's 2 to 4% a month for near the money strikes. Once again, I like monthly options. Then we decide on the moneyness of the option. In the money is a more defensive position. Out of the money is a more bullish position. Then, once we have those determined, we go to an options chain. We look for strike prices either in or out of the money, depending on our market assessment, personal risk tolerance, chart technicals. And then we look for strikes that will give us our initial time value return goal range returns. And that will dictate the strike. That strike will then have a particular delta. But we got there by incorporating what our goals are, and one of them is not to achieve a specific delta. And we could check these option chains and then put that information into the multiple tab of the Elman calculator, and that will do all these calculations for us. Now, just let's review this podcast. Option Greeks, including delta, are important to understand, but they should not be overemphasized. I believe, in my humble opinion, that folks that pick a strike based on delta are emphasizing the wrong factor. Our investment plan should be made on initial time value return goal range, market assessment, and personal risk tolerance. That will differ from investor to investor. Now, once these decisions have been determined, delta will come automatically. But we will not place the emphasis on delta itself, but on the factors that reflect the goals and our risk tolerance of the strategy that we're using, in this case, covered call writing. Now, for those of you who do not have a copy of the Elman calculator to do these calculations, if you go to our website, www.thebluecollarinvestor.com, look at the top black bar and click on the link for free resources, including the Elman calculator. You'll find that calculator, its user guide, the put calculator, and several other free files that will help enhance your trading returns. We also have videos available, beginners tutorials on covered call writing and put selling. Our blog page has a sign-up sheet for our free newsletter. Feel free to take advantage of all of these free resources. And in the bluecollarinvestor.com store, we have online streaming DVD programs, video tutorials, ebooks, hard and soft cover books, as well as calculators, spreadsheets, trade planners, and online mentoring programs. So feel free to have a look in the store, and there's plenty of resources that will help elevate our returns to the highest possible levels. I want to thank all you folks for taking the time to listen to this BCI podcast, number 46, Should Delta Be the Sole Criteria for Covered Call Writing Strike Selection? Now we know the answer is no. I want to thank everybody for taking the time to listen. I hope you enjoyed it, and I hope it puts cash in your pocket. As always, this is Alan Elman, the Blue Collar Investor. Take care, everybody.